dependent situations. All right, okay. So tricky dependent situations. This is a new training from this year. I want to give a shout out to Teresa for providing a lot of really helpful materials in building out this presentation. But we are going to talk about three main things: the support tests and determining support for a dependent, the tiebreaker rules for when more than one person might be able to claim a dependent, and then special rules for divorced and separated parents. So for those of us who are tax site veterans, we know that determining both qualifying children and qualifying dependents involve a support test, but there are different tests for both of those categories. So to be a qualifying child, the child cannot have provided more than half of their own support. And to be a qualifying relative, the taxpayer must provide more than half the person's support. When we are calculating the amount of total support, taxpayers should compare their contributions with the entire amount of support that the person received from all sources. So like, what are they paying for themselves? What are government programs in some cases, paying for, et cetera, et cetera. There are three common situations I want to just name from the top when determining support. A scholarship received by a child who is a student isn't taken into account when determining whether the child provided more than half of his or her own support. Next, payments received under Temporary Assistance for Needy Families, or TANF, or other public assistance programs used to pay the costs of keeping up the home can be counted as money the taxpayer paid. And Social Security benefits that are SSDI, Social Security disability benefits, received by a child and used towards the support are considered to have been provided by the child, whereas SSI, Supplemental Security Income, is counted as support from the state. This is very tedious and specific information. This is in the footnotes of the Pub 4012 around the qualifying children and relatives sections. So you can see all of this information does come from there. Okay, so let's zoom in on these types of disability payments and who provides them for tax purposes. So if the taxpayer themselves is disabled, Social Security benefits reported on SSA 1099, that's retirement, survivors, or SSDI, count as support provided by the taxpayer, right? If they are disabled and it's in their name, that's support provided by them. Whereas Supplemental Security Income, also called SSI, is counted as support provided by the state. SSI does not have a tax form because it's not taxable ever. So that is a way to start to determine if that's that source of income. If the dependent is disabled, Social Security benefits reported on an SSA 1099 in the dependent's name count as support provided by the dependent themselves. Whereas, same situation, Supplemental Security Income, SSI, count as support provided by the state. And any income from work, including sheltered workshop, count as provided by the dependent. Sheltered workshop is specific type of work payment specifically for disabled individuals. So when you're answering these questions in the qualifying child and qualifying relative tables, and it asks in qualifying child, did the child provide more than 50% of their own support? If they receive Social Security that's not SSI, and if they have income from work, that is, and it's going towards their living expenses, then that is considered provided by them. When you do need to determine who provided more than half of a person's support, you can use the worksheet for determining support in the Pub 4012. It's on page C10 this year. And this gives you an opportunity to really break it down with the taxpayer if you all are not sure. So funds that belong to the person you supported, so funds that belong to the dependent, expenses for the entire household, expenses for the person you supported, and then it helps you calculate, did the person provide more than half of their own support, or did you provide more than half? Also want to note that determining support for dependency determination is different from determining if the taxpayer paid more than half the cost of keeping up the home for head of household determination. This needs to be determined, of course, to claim head of household or qualifying surviving spouse. There's a separate worksheet to use in the 4012 on B16 for that. Okay, so let's talk about some examples. These are from the 4491 from the IRS. Sherry's father received $2,700 from Social Security, but he put $300 of it in a savings account and spent $2,400 for his own support. Sherry, who's his daughter, spent $2,600 of her income for his support. His total support needed for the year was $5,000. Who provided more than half of the father's support? Sherry or her father? Okay, the answer for this one, yes, Edwidge is right. Sherry did. Sherry spent $2,600. The father spent $2,400. He put $300 away to savings, and that wasn't part of his support for the year. So per the IRS, it's only the amount actually spent on the person's support. So she provided $200 more. That brought her over the halfway line. The different taxpayer, Steve, he provided $4,000 toward his mother's support during the year. His mother had non-taxable Social Security benefit payments of $4,800 and tax-exempt interest of $800. She used all of it for her support. So the total expenses for the year were $9,600. Who provided $4,000, or who provided more than half of the mother's support? Steve or the mother herself? Yep, Patricia says the mother, right? So Steve's mother provided more than half of her total support of $9,600. Therefore, Steve would not be allowed to claim his mother as a qualifying relative. All right. We also want to talk about totally and permanently disabled. We know that older individuals can be claimed as qualifying children if they are permanently and totally disabled. The IRS considers a person to be totally and permanently disabled if he or she cannot work because of a physical or mental condition, and a qualified physician must certify that the condition has lasted or can be expected to last continuously for at least 12 months, or that the condition can be expected to result in death. It is not necessary to include a physician certification with the IRS returns, but taxpayers claiming to be permanently and totally disabled or blind need to keep a physician certification in their records, right? They are, again, responsible for the burden of proof. When you file the Maryland return, it does say you need to include this certification. For the most part, I've seen the returns go through without them, but again, of course, you can attach it for due diligence, and the taxpayer needs to have a record. If the Social Security Administration has determined someone to be disabled, we can assume that they meet the IRS test for disability. However, not having payments from SSI, SSDI, or Medicare does not mean that they're not disabled, right? It can take months or years after the onset of disability for payments to actually begin. People can receive some income from work and still receive disability income. However, a person is not considered totally and permanently disabled by the IRS if he or she can engage in substantial gainful activity, which is defined as his or her ability to work full or part-time in a competitive work situation for at least minimum wage. This does not include sheltered employment, which is work at qualified locations, specifically for physically or mentally impaired individuals. So that would not be included in being able to work. But the fact that the person did not work is not evidence that they cannot work. Lisa asked, does dementia and Alzheimer's count as a permanent disability? Yes, if a physician has determined that it's going to last continuously for at least 12 months and the condition can be expected to result in death and they cannot work. So when it comes to determining qualifying children who are potentially considered totally and permanently disabled, there's a lot of factors you need to think through. and kind of determine, are they able to work versus are they not working, and are they considered disabled? All right. If someone meets the conditions to be the qualifying child of more than one person, only one taxpayer can claim the child as a qualifying child for the following tax benefits. Before I read through them, do want to note that if there is a special rule for children of divorced or separated parents or parents who live apart, we're going to go over that next. But so if someone can be a qualifying child of more than one person, only one taxpayer can claim them as a dependent, child tax credit or credit for other dependents, head of household filing status, credit for child and dependent care expenses, exclusion from income for dependent care benefits, earned income tax credit, and the premium tax credit. If two taxpayers have the same qualifying child, then only one taxpayer can generally claim all of the benefits for that particularly qualifying child. They cannot agree to split benefits. Again, this is not for divorced and separated parents. The other taxpayer cannot claim any of these benefits based on the same qualifying child. When both taxpayers are the child's parents and not filing a joint return, they may agree between themselves who will claim the child, but this doesn't always happen. So in that instance, we would need to use tiebreaker rules to determine which taxpayer can treat the child as the qualifying child and claim the benefits. We would need to apply these rules for any children, including adopted children. That's treated as a taxpayer's own child. So first thing is, if only one of the taxpayers is the child's actual parent, the child is the qualifying child of the parent. If they're both parents, or they're both not parents, then they're going to go to the person the child lived with for the longer period of time during the year. And then if no parent, sorry, let me restate that so it's clear. So if the parents do not file a joint return together, but both parents claim the child, IRS will treat the child as the qualifying child of the parent that the child lived with for the longer period of time during the year. And if they lived with the child during the same amount of time during the year, the IRS will treat them as the qualifying child of the parent who had the higher AGI, adjusted gross income, for the tax year. But if no parent can claim the child as a qualifying child, then the child is treated as the qualifying child of the person who had the highest AGI for the tax year and meets all of the other tests in the qualifying child chart. If a parent can claim the child as a qualifying child, but no parent does claim them, the child is treated as the qualifying child of the person who had the highest AGI for the year, but only if that person's AGI is higher than the highest AGI of any of the child's parents who could claim the child. These tiebreaker rules are very wordy and a little confusing, but think of it as first, parental status trumps all, then length of time the child living with the child during the year, and then adjusted gross income. And this is only for people who meet all the other requirements when you go through the chart. If the qualifying child is claimed on more than one tax return in a given year, the IRS will apply these tiebreaker rules to determine who can receive the benefits. All of this is in the Pub 4012. It's on page C4. It's a chart called Qualifying Child of More Than One Person. If this is a situation you're doing in real time at a tax site, please look at that chart, because obviously it is complicated. Let's go ahead and do a quick practice example. So Mary and her 3-year-old daughter, Jane, live with Mary's mother, Dorothy, all year. Mary is 25 years old, unmarried, and has an AGI of $19,000. Dorothy, who's Mary's mother and Jane's grandmother, has an AGI of $25,000. Jane's father did not live with Mary or Jane. Mary has not signed a Form 8332 or a similar statement giving permission to the father to claim them. So who qualifies to claim Jane as a qualifying child? Oksana says Dorothy, her grandmother. Kate says Mary, or Dorothy. Gloria says Mary. Yeah, so if we went through the chart in the Pub 4012 for qualifying child, Jane could be a qualifying child of Mary or Dorothy because she meets the relationship, age, residency, support, and joint returns for both of them. So they can agree to let Jane can say, yes, Mary can claim her. or Jane can claim her. If Mary and Dorothy cannot agree, only Mary would be allowed to claim Jane as a qualifying child, right? Because she has the parental status, she trumps Dorothy as the grandma. But it is totally okay for them to agree and say Dorothy's going to claim. What if Mary's AGI is $28,000? So higher than Dorothy's. In that situation, based on the tiebreaker rules, only Mary can claim Jane as a qualifying child because Dorothy's AGI isn't higher than Mary's. So Jane has the parental status and a higher AGI, meaning she's the one who can claim her. If Mary's AGI is higher than Dorothy's, Dorothy cannot claim Jane. Gloria's got it, only Mary. So again, in this situation at the tax site, we need to use that chart on page C4 as we're going through. Obviously, we would use the qualifying child chart first, but then move on to C4 as well to verify who can claim the dependent. Sometimes no one provides more than half the support of a person, right? They might have multiple people contributing to their support. A multiple support with the IRS means that 2 or more people who could claim the person as a dependent, except for the support test, together provide more than half of the dependent's support. In this situation, the individuals who provide more than 10% of the person's total support and who meet the other tests for a qualifying relative can agree that one of them will claim the person as dependent for any applicable tax benefits. In this situation, the taxpayer who claims the dependent has to file Form 2120, that's a multiple support declaration, or a similar statement with their tax return. And this is something we can do at VITA, it is in scope. The other taxpayers providing over 10% of the support, but who are not claiming, must provide a written and signed statement agreeing not to claim the dependent for the year. And the person who claims the dependent must keep a copy of this written statement as a record. In Form 2120's instructions, it has all this stuff that is requirement. But note that these multiple support agreements only apply to a qualifying relative, not a qualifying child. And if you claim a person as dependent only because of a multiple support agreement, right, you're only providing more than 10%, not 50% of their support, that person is not a qualifying person for head of household. So this situation could look something like this. We have Fred's father named Charlie. He lives with Fred and receives 27% of his support from Social Security, 40% from Fred, 24% from Charlie's brother Ray, and 9% from one of his friends. So we'll assume that Charlie might be a qualifying child of either Fred or Ray, other than the support test, but they did each provide over 10% of the support and together contributed to more than 50% of his support. Who can actually claim him on their return as a qualifying relative in this situation? So assuming they both meet all the other tests other than the support test for qualifying relative, Charlie could be a qualifying relative for either Fred or Ray because they both provided more than 50% and together contributed more than 50% toward his support, but they have to agree on it. So for example, if they agree that Fred is going to claim Charlie as a dependent, then Ray will have to sign the 2120 and Fred will attach it to his tax return, right? And this is just for the 1 year. Doesn't matter that Fred provided 40 and Charlie's brother, who's Ray, only provided 24 because they're both less than 50. They technically need to decide and use the multiple support agreement. Liv, yes, they could switch every other year. Absolutely. All right, so there's a special set of rules for divorced or separated parents, parents who live apart. In most cases, the child is the qualifying child of the custodial parent. According to the IRS, the custodial parent is the parent with whom the child lived for the greater number of nights during the year, and the other parent is considered the non-custodial parent. If the parents divorced or separated during the year and the child lived with both parents before the separation, the custodial parent is the one with whom the child lived for the greater number of nights during the rest of the year. And a child is treated as living with a parent for a night if the child sleeps at the parent's home, whether or not the parent is present, or in the company of the parent, whether the child does not sleep at a parent's home. So like on vacation together. If the child did live with each parent for an equal number of nights during the year, the custodial parent is then going to be the person with the higher AGI again. So following the same pattern as the tiebreaker rules, first number of nights you live together, and then AGI if it's equal, if the number of nights is equal. All right, so the child can be treated as the qualifying child or relative of his or her non-custodial parent if all of the following conditions apply, right? We said it's usually the custodial parent, but if all of these apply, they can be treated as the qualifying child of the non-custodial parent. First, the parents are divorced or legally separated under a divorce or separate maintenance decree or written separation agreements, or lived apart at all times during the last 6 months of the year, whether or not they are married. Second, the child received over half of his or her support for the year from the parents. 3, the child was in the custody of one or both parents for more than half the year. And 4, the most important, the custodial parent signs a written declaration, this is Form 8332, that he or she will not claim the child as a dependent for the year, and the non-custodial parent attaches this declaration to his or her return. If this form is filled out, the 8332, this only grants the non-custodial parent permission to claim the child, right? So they are a dependent and get the child tax credit or the credit for other dependents. This does not give them head of household filing status, does not give them the credit for child and dependent care expenses or the earned income credit. For these benefits, the child must meet the residency test, so the custodial parent may still qualify for those provisions, even if they are giving up dependency to the non-custodial parent. At any point, a custodial parent can revoke a release of claim to exemption that they previously provided to the non-custodial parent, and they do this also on the 8332. The custodial parent must provide or make a reasonable effort to provide the non-custodial parent with written notice of the revocation in the calendar year prior to the tax year in which the revocation is to take effect. And like I said, it'll be done directly on the 8332 in Part 3. That needs to be attached as a copy to the return for each tax year the child is claimed as a dependent as a result of the revocation. All right, so in TaxSlayer, when this situation is happening, if the non-custodial parent has gotten the 8332 signed, right? The custodial parent said, yes, it's okay for them to claim them. You have to say, check if you wish to not claim this dependent for earned income credit purposes. And the custodial parent, they're not claiming them as dependent, so you still input them as a dependent, but check if this qualifying child is not your dependent, right? Because the other person is going to get the child tax credit or credit for other dependents. All right, what questions y'all have about these less straightforward dependency situations? Lisa asked, in either scenario we just looked at, would filing as head of household have an impact on who can claim an individual? So in that situation, the custodial parent still gets to be head of household. They can't give that up to the qualified child because the child, or to the non-custodial parent, because the child has to have lived with them for more than half the year. So they keep head of household, they put the dependent on their return, but do check that box that says it's not your dependent, and that will stop them from getting just the child tax credit or credit for other dependents. The custodial parent still gets head of household if they meet the married or considered unmarried rules. All right, before we wrap up this section, I do want to just give my constant reminder of when it comes to dependency, folks should be, particularly volunteers, should be using the Pub 4012 every single time, right? These rules get complicated. Every situation is different. So when your volunteers are sitting down with the taxpayer before they even go into TaxSlayer, they need to go to tab C of the 4012 and determine who is a dependent. We always start with table 1 for all dependents, go through it. If they can be qualifying child, straightforward, great. If you need to go to the qualifying child of more than one person, go to that. If they can't be a qualifying child but might be a qualifying relative, use that chart. This is the table for children of divorced or separated parents who live apart. This is what we just talked about. This is about having that agreement signed. And then back here at the top at C4 are the tiebreaker rules for a qualifying child of more than one person. That walks you through if more than one person can claim them and there's no agreement made, then these rules need to be abided by. Teresa sent us a beautiful summary. Like I said, Teresa has a great one-pager about this where I got a lot of information. So thank you again, Teresa and Community Tax Aid. Gloria asked if the wrong parent claimed child, will the return reject and need an IP PIN? Yes. So if someone has claimed the child incorrectly, and then the correct parent goes through, their e-file will get rejected for a duplicate TIN, taxpayer identification number, but they will be able to e-file that if they go and get an IP PIN. My understanding of that new system is that if they get an IP PIN for the child beforehand, then of course the wrong person won't be able to claim the person without that IP PIN.
See?
Yes.
So just to clarify, Gloria, if the wrong person files first, it's still going to go through. The IRS is not determining at the moment of e-filing who's supposed to claim who.
Correct. Yes. Sorry. I read it a little.
Yeah. And
Yeah.
then, and then you can't get an IP PIN for a child for this situation because it's always going to have to be if both people file, who's going to figure it out. IP PINs are issued for other situations, but never for this dispute of who can claim them.
Okay.
The IP
So
PIN is going
the
to be
person will
for
just
the
get an IP PIN
taxpayer.
for themselves.
Correct.
Gotcha.
Yeah.
And then the IRS will take over determining. So yeah, Gloria, the IRS will not know at time of e-file for the first person. All right, any questions about dependents or any of the tax law stuff we went over?
I'm just thinking about different types of children now. So, like, if they're a college student or if they have childcare, with the, childcare related, deduction or college credit go under the parent who is paying for that, regardless if they were claiming dependency or not.
So for the child independent care expenses credit, that stays with the custodial parent.
Okay.
In that divorced and separated agreement. If it's
hmm
a non-parental qualifying, like you're a qualifying child, but you're not their parent and all other rules are met, then yes, you would still get the child independent care credit for them. Essentially, they have to be listed on your return for you to get that credit for them. It's very similar with tuition and education expenses. If the dependent is on your return, then you should claim the credit for them.
Okay.
All right, I am stopping our recording.